The volatility, is it scaring people? Is it scaring you as an investor?
I think it's scaring people. I don't think I have the luxury of being scared. I'm supposed to be a professional investor. That's why folks bring money to us. So the question is, can you separate some of the fear from some of the probabilities? In our perspective, look, I have no idea what the market's going to do in a couple hours when it opens, and I have no idea what the next 1% move is. Is the S&P worth 10 to 20% less than it was a month ago? I don't think it is. And so then the question becomes, how do you look through it, find opportunities, and put money to work responsibly? And that's what we're trying to do.
So where are you finding those opportunities right now?
So we raised some cash over the back half of last year as markets were kind of hitting highs, so we had some cash to deploy. And then the way we're thinking about it is buying at intervals. We're not looking for events. We're looking for percentages down.
So it's large price intervals, not time intervals.
Yeah, it's price intervals. The idea being that, if we are medium to long-term constructive, which we still are, if we like it at 5% down, we like it a little bit better at 10. Large cap growth has been the area that we've focused our buying on. We think that part of the market is perceived as a little bit safer. That growth is seen as a little bit more secular. And we like the opportunities there. As we move further down the line, if markets are lower, we'll start to evaluate the value sectors.
All right, so Brian Kelly, let's bring you into this conversation right now.
Yeah.
Is there anything that you've seen over the course of the past week that hasn't scared you? And are you in there buying up the markets right now, given the sharp sell-off that we've seen over the course of the past several days?
So listen, I think there's an opportunity here, if you're going to be nimble and you're going to be a trader, to play for this central bank government stimulus that we're starting to see come in. I think that's what the market's starting to price in, the equity market. It's already happened in the bond market. We're pricing in close to 50 basis point cuts, almost 100 basis points by the end of this year. So that has happened there. The equity market hasn't adjusted to that. And so we have multiple central bank meetings coming up this week. We have an OPEC meeting, which is the central bank of oil, coming up. And then we have the Federal Reserve meeting coming. So I think there's a period of time here while cases in China start to go down. If it looks like it's contained globally, or at least starts to slow down, and you get central bank stimulus, then you have a period of time where you can probably be nimble in this. My concern is the uncertainty. You talked about how everybody is panicking and how everybody's going to Costco and there's a line around the door. If everybody continues to have that mentality and you have Apple stores and Starbucks stores closing down in the U.S., then I don't think this is a time to buy. But frankly, I don't know, and I don't think anybody else does.
I mean, nobody's thinking that Apple and Starbucks stores are fair point. They're going to close in the U.S. at this point. But Peter, Brian brings up an interesting point here. Central banks, the focus of Goldman's note. And we talked about it the last half hour, but it's worth mentioning again. David Kostin, the chief strategist, says that earnings growth in the S&P might be nothing this year. Now you've got John Hatzius and the economics team saying that they expect a half a percentage point rate cut from the Fed at or before a March meeting, the meeting that happens this month. Also an additional 0.5% of cuts in the second quarter, rate cuts from other developed market banks. Should the Fed be acting so aggressively intra-period, if they are going to cut rates, does it send more panic in the markets if they do it before their next meeting?
I believe so. If their next Fed meeting was 6 weeks from now, you can make an argument that they should do it before, but we're talking 2 weeks from Wednesday. So they can't wait for 2 weeks. I mean, we're not in the middle of a financial crisis. We're in the middle of an hysteria more than anything. So do I think a Fed rate cut is going to matter whether it's tomorrow or 2 weeks? It really shouldn't. But, there's an extraordinary amount of peer pressure because earlier in the show you talked about, 10 years we've been medicated on this, and every dip has been bought because the thought of the Fed put, the central bank put. So we've become accustomed to central bankers somehow saving us. But I do want to remind people, remember what happened the last 2 rate cutting cycles.
All right, Brian, you were saying.
Well, I mean, listen, I agree with Peter in that, economically, it doesn't matter whether you get a 50 basis point rate cut today or in 2 weeks, and we can argue whether that would even change the economic picture. But I think psychologically it does. I think psychologically for both investors and for the investing public to have that central bank come in. Now, I'm not a fan of this, but I think just as a pure psychological factor, the sooner that central banks act, The sooner
Sure.
that there's global
Brian,
coordination,
I want my
the
candy
better.
today. I don't want to wait till tomorrow. Of course.
All right,
Exactly.
Gentlemen, everybody wants their candy. We've been medicated on it, like you said. Steve, we're going to give the last word to you here. What's your takeaway from this, and what are you doing today?
I think two things. Number one, I think there is a role for the central bank here in as far as small businesses. Small businesses that may have demand delayed if folks aren't coming out, they need a tide over. Our play is the following. Yes, earnings growth is going to be lower. The year doesn't end on 12/30, or the world doesn't end on 12/31. There's going to be earnings growth in the years ahead, and we want to buy stocks.